because all of this is just going to be sentimental. The bounce here does give a bit of an inverse head and shoulders off the low of the day, but I don't think it's good that we've like double bottomed and then failed again. And the rhetoric, isn't de-escalating, especially with Trump's with Trump, now pushing, even more trade restrictions. So, um, obviously that was really bad into close. We got a tiny bit of mean reversion there, but still closing red on the day, and NQ taking an even bigger hit on top of that. So I will say that Dow and Russell performed a little better with JPow's speech, not changing the path of Fed rate cuts too much. But this doesn't look great. I mean, it looks like we had a bear flag. It failed. That bounced. And we got a slightly higher high, but that failed also. So I'd be watching the 6680 level in the overnight session, and 6700 to the upside, which we're right in the middle of. Failure there and below the end of day VWAP probably opens up a retest of the prior week close. Which we got earlier today as well. The third test of that level, probably not a good thing. Dollar actually dropped a little bit today finally after it was like 6 days of straight rallying. Gold went up a little bit, silver sold off, copper sold off, and oil sold off back down to $58, which I do think is very low for oil. I would project oil to get up to like 65 a barrel at some point. But if economies keep weakening, especially EU, and potentially growth slowing in the US, then oil may not be done bottoming. However, it is easing price pressures a bit. If oil were higher, the Fed would be far more concerned about things. Once again, we see correlation breaking down after a big push, or dispersion breaking down after a big push into it this morning. Um, Correlation on the 1 and 3 month, or the 1 month and 3 month, are not nearly as high as they were at the peak of our drop here. But there is some consolidation going on there in the dispersion trade, and I'm not entirely sure that consolidation is going to see correlation reverse back. Bank earnings were okay, but there were some warnings from JPM about credit risks that might be kind of shaking things up a bit. I know Wells Fargo did significantly better than expected, but not all of them did. And we still have more bank earnings to report for the rest of the week as well. Um, we touched on commodities already. Bond volatility flattened out a bit yesterday because it was closed. But it still looks like there's a ton of demand in the 2 and 5 year in the belly of the curve right now. The 10 year is almost down to 4%. So we're still seeing some flight to safety. It's just not as extreme as it was last Friday. Remember, any announcements moving forward could drive more of that reflexive response. And in line with that reflexive response, as people go longer and longer bonds, they're also going to continue to demand long volatility. And today we have our first close since Friday with a positive forward yield on volatility. And we see the 10-2 has moved up to about 21%. This is starting to be a little bit more durable than our prior moves over the course of the rally into a positive forward yield on volatility. And something notable about this is that the 10-2 curve is moving. Like we're seeing that increase alongside the increase in demand for volatility, and those are the exact conditions that preceded the drop in April. And also in Feb to March, we saw not as obviously not as extreme, but we did see a fairly significant amount of that. Both of those yields steepening over time. And then skew bounced a little bit, so a little bit more downside protection possibly. Um, really don't think the turnaround in breadth is very impressive. And we are starting to get more positive correlation between VX and cash VIX, moving up to 51.29%. Remember, just a few days ago we were like negative 34%. So this is quite a big move in positive correlation, but they're still not well correlated. I mean, they're not where they should be, which is in the 90% range. So there's quite a bit of room for that to continue to improve. Rate cuts pricing in 64 points by June of next year, 42 by March, and like one cut by the end of this year, roughly. I'm pretty sure chances of a October cut right now are still around 90%. And the December cut may have dropped off a little bit over the week. We see the 10-2 steepening by about 3.6% today. And leverage is down. So this is kind of an important chart. This is BTIC on adjusted interest rate and S&P total returns for EFFR futures. Basically, this is a very good measure of like underlying liquidity demand, so demand in individual equities within the index. And you can see that rises in leverage on that tends to lead to correlated rises in price on SPX. We see leverage falling here, which is also something we see in the options market as well. So both of those, both the options macro side on Gamma Strike and this, kind of pointing at the same thing, which is that there's some risk off going on. I would also say that that's really obvious in BTC as well, which I know many consider to be something that I don't, but I always consider BTC to be, simply dollar leverage, and not only is the increasing risk in the dollar making that less attractive, but risk off in very compressed margin ratios is probably leading to quite a bit of selling in crypto. Um, we retested the 20 MA today, failed it again. We got a little bit closer to testing the 50 MA as well. We closed above the 30, so I mean, there's a slight bullish bias on our close. But if the 30 MA were slipped in the overnight, which is around that 66.20 level, I would say that we should be looking at a MA 50 test before the end of this week to the downside, which means a loss of a fairly significant level at 6,600, and then our gaze is going to shift out to 6508, which is that August high, before we drop into the trading range from August, which would be pretty significant. There was a lot of leverage and buying packed into the like August to September, or August through September move. So there's quite a lot of exposure here, and if that starts, falling off, things could get very ugly very fast. And yeah, so most of the gains today we're seeing we're in finance and retail trade. And we're seeing consumer services and consumer non-durables pick up, process industries, commercial services, communications. Non-energy minerals are still performing well as fears increase over Chinese export controls on rare earth minerals. And so I would say that there's a little bit of an indication that there's some sector shift here, maybe pulling out of tech, backing into financials where there's at least some perceived safety. However, I could see financials getting abandoned pretty quickly as well, especially if the Fed chooses not to cut. McDonald's as a service is funny. They're a real estate company and food distributor, so yeah, they're a service. Most of their money is made providing services to their franchisees, some of which is real estate, the rest of which is food distribution. But yeah, I would argue that that's correctly placed. Yeah, they're they're definitely not food. They are. They own the majority of their supply chain from the ground up. If you're like a McDonald's franchisee, you source your food from McDonald's. They deliver it in McDonald's trucks from McDonald's warehouses, and you pay, McDonald's premium on having that service rendered. You order your clothes from McDonald's warehouse, like you order your employees uniforms from McDonald's warehouses, you order your advertising materials from McDonald's. They make toys, yeah. I mean, one would argue before streaming services that Disney wasn't that either. Anyway, yep, that's it. So thank you guys for tuning in. I'll see you bright and early tomorrow. Later.